Social media influencers have a pretty big responsibility these days because they have a lot of eyeballs on them, and whatever they say, especially if they have a big following, people tend to believe. I'm not talking about myself. I'm talking about somebody that I have some beef with, MeetKevin. He has a ginormous following, almost 2 million on YouTube. And while I don't know him personally, I can tell by watching his videos that he's a very, very smart guy and actually a pretty good dude. But I got some beef with what he's doing and the direction he's taking his channel. But before I get into my beef with MeetKevin, I want to introduce myself. My name is Sam. I'm a real estate investor. That's the only space I stay in. I own $40 million worth of rental property I bought without using any of my own money. And I also own a house buying company here in St. Louis that flips over 300 houses a year. So I am in the real estate investing space. So I'm kind of in the finance space, which is similar to what MeetKevin is in. While I do other investing, I have stocks, I have crypto, I have e-commerce stores, I do dabble in those spaces. I don't pretend to be an expert on everything. I'm an expert in real estate. My audience might not be as big as other people's on social media, but I don't know that there's anybody that has more experience and is more actively involved in real estate investing than I am. I started following MeetKevin a few years ago when I saw one of his videos where I think he was walking outside and he was walking through the snow with his dog and talking about investing. It was a 10-12 minute video and he did it all in one take. I was like, holy crap, there's no way in hell that I could do that. It takes me 30 minutes to shoot a 2-minute clip because I'm not as articulate and as talented as him on camera. So that initially drew me in. Super smart, super articulate, super good on camera. And I started following his channel and watching his videos, and they were all backed by a bunch of data. He had supporting graphs and supporting charts and had, all this fancy stuff going on. It was super, super impressive. So I definitely became a MeetKevin fan and would check out his videos from time to time. So then about 6 months to a year ago, I started noticing a new trend on his channel. I would go over there to maybe get video ideas or just kind of see what he was talking about. And holy crap, I burnt my face on the screen because there was so much freaking fire coming out of his thumbnails. You scroll through his channel and all you see is fire, crisis, crash. The world is ending, the economy is crashing, you should sell everything. Nothing's gonna be the same, this is gonna be worse than '08. That's all you see when you're talking real estate, when you're talking the stock market, when you're talking crypto. All he does is go negative, negative, negative. When I watch the videos, I tend to mostly, not always, agree with what he says, but the video doesn't always match the thumbnail as far as the tone. It's almost like a bait and switch type situation. I get the social media algorithms. I understand that you want people to click on your video and you want a high CTR. You want to have a thumbnail that is catchy and that grabs people's attention so they click on it, because you're not going to get views unless you get clicks, and you're not going to get paid unless you get clicks. However, I feel like he has crossed the line over the past few months, as I stated recently. The reason for that is most people don't actually click on a thumbnail that they see. He's crushing it and probably getting a 10% click-through rate, meaning if 10 people see his video, one of them is clicking on it and actually watching it. So that means 9 people, or 90% of people, do not know what he's actually saying in the video. When you actually watch the video, you see that he thinks that it could be a crash, but he's not overly worried. He understands there's still opportunities, and he's a pretty responsible investor as far as I can tell. However, 90% of people, and maybe even higher than that, my click-through rate's more like 4 or 5%. His is probably at least double that, but at least 90% of people that are scrolling through YouTube or scrolling through his channel do not click on the videos, so they do think that MeetKevin thinks the world is ending. So they do think that there is going to be a crash. They do think that it's going to be worse than '08. So it just starts this fear-mongering cycle of, I scrolled through YouTube, I saw MeetKevin, I saw whoever else out there that is making these clickbait negative thumbnails, even though the content doesn't quite match it. So then you start to see that over and over again. It starts to get ingrained in you that I don't need to watch these videos. I don't want to be scared. I just know that the market's going to crash, and that makes me nervous and that makes me scared. And I don't really vibe with that. My thumbnails don't get as good click-through rate, but they are what the video is about, and they're not trying to fear you. They're not trying to scare you into watching the video so you can get clicks and I can get money. Let's take a step back and define the word crash, because that is used so frequently on MeetKevin's channel. A crash is over a 10% drop in house values, not house list prices, people dropping the list price of their house. That has nothing to do with the value of a home, what somebody lists it for. So the 10% drop in actual house sales, which equates to house values. In 2008, so from that 2007 to 2009, the worst dip, you look at the Freddie Mac chart that MeetKevin uses all the time, that was about a 23% dip nationwide in the median house price. So the worst of the worst, it dropped 23% on average in the US over a 2-year period. So that was a crash, but just barely over 10% each year. Now, some markets were hit worse, of course, some were hit less, but I'm just talking about national average because that is the average. Now, I don't see anything like that happening again. People list houses for certain prices and do certain things. I'm talking about house values, which equates to house sales. Take a step back. Even in 2007, 2008, MeetKevin rightfully says that's not a good comparison for people. That scares a lot of people to compare things to that, but let's just do it. Back then, houses overall did not dip as much as people like to say. Certain areas did, and commercial real estate got hit really hard. But I'm talking to the people that invest in single-family rental properties, invest in rental properties the right way. So it did dip a decent amount, but it took a couple years to do that. And there was a ton of bad subprime loans out there. People had mortgages on properties they could not afford. People would literally white out a loan application and just make up how much money they made so they could afford their third house. And it was a complete mess, nightmare behind the scenes. Now, banks do not do that. Mortgage companies do not do that. People can generally afford the houses that they're living in. And as the economy probably will go through recession, people have never had more equity in their houses. Over the past couple of years, people's houses have gone up 10, 20, 30%. So even if the market does dip 10%, 15%, they're still going to be where they were in 2019 as far as the home value of their house, which nobody thought 19 was a crash. So the fact that we've had such a drastic upswing that you can see in all the charts over the past 12 to 18 months, that means we can have a decently drastic downswing and still be where we should be, and people still will not be underwater because a majority of people have not sold their houses, hence a very, very low supply. It's ticked up a little bit recently, but overall that's because the demand has dipped a little bit because it's summer and things are happening and people are active. So there's been a huge upswing, and a decent downswing will put us right where we need to be as far as the normal steady curve of real estate going up at a decent clip every single year. So just having a little perspective and knowing that a crash, while that's a catchy thing to put on a thumbnail, means a 10% drop in a year, which isn't even a percent a month if you can do math. So you can see things do move slowly over time, and if you're actively investing and you're buying at 20 to 30% below market value like I teach my students to and like I do, you're going to be just fine. So just don't over leverage yourself, have some perspective, and look at the 150-year chart and see that real estate always goes up. And if you manage it properly, you're not gonna have any luck trying to time the market. It's all about time in the market. You're not gonna buy every single dip and sell every single height. You just continue to buy, and over time the property will be worth more than it was when you bought it, as long as you manage it properly and don't over leverage yourself. While it's scary to see the thumbnails of those videos, when you actually click on them, you will see that the world is not ending and things are not as drastically bad as that thumbnail may make it look. Hopefully this video has taught you to maybe just look at MeetKevin's channel with a little bit more critical of an eye. And shoot, maybe this will help his channel because you'll actually click on those scary videos, and once you watch them, you realize that things aren't really that scary. So what I want to do over the next couple minutes is take some points from MeetKevin's actual videos and talk about how they magnify my issue with him. He says one thing on a thumbnail and does another thing in a video. So let's talk about where he's kind of contradicting himself now.
Some say, Kevin, there's a reason why the most dangerous words in investing are "this time is different." And so even though I believe it's right to be bullish on the market, and even though I'm 95% in this market, there's a substantial danger. And that has to do with the chart that is right here. This particular chart tells us that payrolls lag a recession. We've known this before. We've talked about this on the channel many times before, but payrolls go down after a recession. In fact, take a look at this. This is the average monthly changes in, or average monthly change, the blue box here, in payrolls. And what you'll see here.
All right, so there's a little bit I want to unpack in this. The first, he said he's very bullish on the market. He thinks it's good to still invest in real estate. if you see and as you see the thumbnails, that's the exact opposite of what you think, especially considering 90% of people see the thumbnails and don't click on them. So 90% of people think the world is ending, it's crashing, and he's telling you in here that he would still invest. The other part, this chart that he pulls up, is from 2020. That was a black swan event. COVID was something that's never happened before, so that's a very extremely small sample size to take when you say that recessions mean that the payroll is going down or whatever he's trying to get across. His point in this chart, don't need to rip it apart too much. And the other part, the most important thing about this video and what I want to get across on this is, in the last 7 recessions, go back and look at the data on this chart. There's been 7 recessions in the United States in the past 50 years. In 5 of them, the real estate market has improved or increased in average home value. Meaning, 5 of the last 7 recessions, the real estate market has done good, better than it was doing before the recession hit. There's 2 recessions in 1970 and 2008 where the real estate market went down, but it wasn't as much as you think in both of those cases. So just take a step back and look, recession does not mean crash. He thinks the market's gonna continue to maybe crash, but he still wants to invest, kind of some conflicting points. So this next video I wanna show you a short clip of is Kevin talking about how good of an investment real estate actually is, which again, you would not think by looking at his channel.
And what I used to say is, if you just started at 25 years old and bought a house for $100,000, and then every 7 years bought a house for $100,000 more, at the end of that 40 years, when you're around 65, retirement age, you would have almost $10 million of real estate with a lot of that paid off. How many people do you know that have $10 million of real estate, let alone a bunch of that paid off? Like, you.
So basically what MeetKevin's saying here is if you buy real estate consistently for 7 years in a row, over time those properties will grow in value and the tenants will pay the mortgage down, and then eventually you're gonna have a lot of real estate paid off. It might take 40 years to get to that point, but it's $10 million that you wouldn't have, and all you have to do is really hustle for 7 years. So during those 7 years, the market's gonna be up, down, in the middle, indifferent. So you can't just wait for the perfect timing. You just gotta invest, like he's saying, consistently and steadily. Over time, real estate's gonna create multi-millionaires. He's even saying that.
I'm not expecting something like a 2005, 2006. So I wouldn't be expecting homes to come down 40 to 50% in price. I'm just not seeing that. You know, at most, I would expect at most maybe a 22% correction, but probably more of a base case scenario is going to be anywhere between -5 to -15%.
So I'm going to try to keep my cool on this one, but MeetKevin basically just said that he doesn't see the market crashing 40 to 50%, which it's never done as an aggregate as a whole, maybe in a couple specific markets, but it's never dropped anywhere close to that. So he's saying that's not gonna happen. Well, duh, but that's what he insinuates in his video thumbnails and titles. Crash is used an exorbitant amount. He probably has crash tattooed somewhere on his body. Crash is written all over his channel. Recession, you know, the market's ending, the world's ending, but he just said he thinks it's gonna drop 5 to maybe 15%. So a 5 to 15% drop over a longer period of time, meaning 1, 2, 3 years, it's not a crash. It's not even really that substantial. If you're buying at 20 to 30% below market value, like I say, then a 5 to 15% dip over a long period of time isn't gonna hurt you. If a property's worth $100,000 and you owe $75,000 on it, let's say it drops 10% over a year or 2 period, which would be pretty drastic. That means it's gonna be worth $90,000 and you're probably gonna owe $73,000 after the debt's been paid down a little bit by the tenant. So you're still looking at a lot of equity. So you're not gonna be underwater with a small dip, which probably will happen. You're not gonna be underwater if you buy at discounts, which is what I always talk about. I never tell anybody to buy at market price. So the 40, 50% that you think when you see his channel, actually I would think that real estate's gonna lose 80% of value if I look at his thumbnails only, which most people just do that. If you actually dig in, even he says it's not gonna dip that bad. And again, he's not a bad guy. I just disagree with the fact that he's fear-mongering, crash, 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 crash. bait and switch. All right, it's actually really not that bad. I think you still should invest, should be aware of this. That's just not my style, and that's just not the style I like to put out there. Maybe if I did that, I'd have more followers, but I'm not gonna go down that path. I'm just gonna hit you with the real data. I'm not gonna find some weird made up charts that no one ever seen. The charts that I use are the charts that everybody uses, the government puts out, the Freddie Mac charts where they actually show simple, realistic data like home values, median home values, like interest rates, like months of supply, not all these weird charts no one's ever seen of. So I'm gonna stick to the real simple charts. I'm gonna talk about supply and demand. I'm gonna talk about my experience. I'm not gonna scare you with a thumbnail and then change my opinion when you actually watch the video. So that's my thoughts on MeetKevin. Again, smart guy. If I ever met him, I'd shake his hand and say, man, you're a kick-ass social media guy. Disagree with how you do it, but to each his own. I'm gonna stay in my lane, you stay in yours, and roll on with it. So hopefully you enjoyed this video. If you got anything out of it, make sure to subscribe to this channel. I give real life, realistic information every single week. So check out this video over here where I talk about what I think the market's actually gonna do and why it's gonna do it based off simple charts. See you on the next one.